Okay, so today is October 11th, 2025, and we will be reviewing IQVIA, which, in my opinion, are the picks and shovels company of healthcare AI. So, in my opinion, they are very much the overlooked AI trade thus far. And just going back to the basics, AI is really composed of three components. One is the compute infrastructure with data centers and so on. We have data, which is where the training is uh, for the models are completed upon, and then we have the AI models themselves, like OpenAI, Anthropic, and so on. So where IQVIA, I guess the services, a big part of what they do is providing the data uh, for healthcare companies to train and do research on, and they pull their data from all these other companies like EHRs, EMRs, insurance, and so on, and that just represents a really big opportunity for them to provide training and research into the healthcare space for companies that need it. So, um, going into your operations, what does IQVIA actually do? So they are the global leader in clinical research, commercial insights, and healthcare intelligence, and they have a few segments such as technology and analytics, research and development, and contract sales and medical solutions. So they were formed through a merger back in 2017 or 2016 between Quintiles and IMS. Very large company and over 90K employees, over 100 countries, and they're one of the largest companies in the world. So they do by far, and this is not marginal amount. This is by far they own one of the world's largest de-identified healthcare data sets in the world, which means that they have tremendous capabilities or foundations to train their AI in the healthcare space. So the segment that I really think is very attractive is the TAS division, where they provide real-world analytics. It's a high margin and recurring revenue compared to research and development, contract sales, which is more cyclical. So TAS, in my opinion, is really the overlooked value proposition, and they have not been recognized as many of the AI trades out there. So let's take a look at the tail and headwinds and moats. So tailwinds are factors and macro drivers that are pushing the company forward, and the headwinds are the opposite, which is going against where the company is going and might cause obstacles or challenges for the company to go forward. So first off, tailwinds or growth drivers. There has been an ever-growing demand for real-world evidence in regulatory approvals and payer negotiations with smartwatches, digitalization of their healthcare systems. There just has been a massive tsunami of data into healthcare, and I think there was a recent report where even when specialists or doctor specialists are reviewing on a daily basis only the materials that are coming out in your specialty on a daily basis, they probably need at least 9 hours, 7 8 hours, 9 hours to just go over the literature. So there's a massive amount of data for healthcare that is coming in, and there's just not enough time in the world to review all this data, and that's in itself is a separate issue. But overall, there is more regulatory push and internal push from within the industry for real world data, which is what IQVIA have sourced, right? So they source the data, the codes, and everything from the actual EHRs, wearables, which is in the live world. In comparison, the other source of data is more so from clinical trials, which might be more in controlled in controlled environments, non-real world environments that may not reflect how drugs and care may actually, or the results from those care may not actually be fully reflected in the real world with all these different factors that might come into play. So in terms of headwinds, while there is pricing pressure from pharma clients and so on, and then for a big part of their contract research services, it ties into the biotech funding cycle. So when there's a high interest rate, when the capital markets are not that great, biotech, their funding reduces, and as a result, they have less budget to work with IQVIA and similar companies to to conduct those type of research. There's also geopolitical factors. There's also FX risk with the de-dollarization or really just the devaluation of the dollar. And given the geographical exposure of over 100 countries that IQVIA has, it's definitely one of the headwinds or risks that they have to account for in in the overall global environments. So in terms of moat, and this is why I like this company so much, is that they have over 1 billion patient records, which is the world's largest healthcare database in existence that companies, pharma companies, research companies can contract and gain access to. And just from the network effects, with having the more networks, you get better analytics, you get better machine learning, you get better AI, and with the high switching costs, the global scale, regulatory trust, and so on, it just puts this company at a really good position in the AI world or AI trade in comparison to other similar companies. And within healthcare, you're probably not going to get a larger healthcare database anywhere else. So from that alone, it has a great moat just to reproduce. Just going back to the moat. So, for example, if you want to replicate what IQVIA does by having that database, you're going to have to go out and form contracts and data pulls from each and every EHR, EMR, hospital, insurance company, and that's going to take years and billions of dollars to do. Like, it just takes a very long time. It's not something that can be done by just pouring money in. It takes time, relationships. So that's why I see that the moat is a very large moat, and it's not going to be displaced anytime soon. And just from that, I don't think there's going to be a reasonable player out there that's going to try and replace IQVIA, given the current cost and effort that it requires to do so. So doing a SWOT analysis, the strengths are going back, one of the largest healthcare databases out there. It's an integrated platform between analytics, CRO, commercialization. There's a massive backlog, so there's visibility into their future revenues. The opportunities, there is a rising demand, as mentioned earlier, from within the industry and from a regulatory standpoint for real world evidence, which is what IQVIA does. It pulls from actual insurance, actual EHRs, data from there, which is the data that comes from interactions with patients to get this data. There's AI that's involved. Provides the data itself provides a great platform for AI ML to train on. For weaknesses, there's a heavy reliance on pharma biotech budgets, which becomes very cyclical. Lower margins versus life science tools. So that's why you'll see, for example, TMO, Thermo Fisher, and as well as Dana Hart, I believe. And that's why you'll see that the IQVIA is trading at a lower multiple, because their revenue is more, correlated with overall market conditions. Whereas for the tools peers, it's more consumables. You're just going to have to reuse it over and over again. That's why they trade at higher multiples, given that their revenue is a bit more resilient. For the threats, you'll have regulatory tightening, pricing pressures, and so on. And one of the things that is lesser mentioned in just online research looking for public opinions is that, which is actually very key, is that for IQVIA, while they still have one of the largest healthcare databases out there, there has been some commentary on Reddit forums and other forums of related to healthcare, saying that the data is a bit more dated. It's not high. It's not for high precision, and it may not generate that much upside for the purposes that they're doing. So that might be something that they have to watch out for, because yeah, so that's just one of the things, one of the risk concerns that we have to pay attention to in considering the overall investability of this company. So for the Porter's Five Forces, which evaluates the different bargaining powers and will power from different stakeholders and aspects of the company. So for the threat of new entrants, as mentioned early on, it's very, very low to get to any close amount of records. You have to form lots of partnerships. You have to pour lots of capital into this. It's not something that can really be done overnight. For supplier power, you have the hospitals, lab insurers. It's very fragmented. It acquires from many different sources, meaning that for the hospital, the data itself to them is really just a byproduct. It really doesn't hold much value for them. So IQVIA is going to have a lot of bargaining power in negotiating the rates in sourcing this this data, and it doesn't really cost the hospitals much once the API, which I imagine is going to be an API, to pull data up. It's it doesn't really cost them much to continue to do that or do it again. For buyer power, it is going to be very high. The top 10 pharma account for over 27% of the revenue. It's a very concentrated client base. I do think that once they start branching out into other areas of the industry that need this data, like ML and AI training, that may not be pharma based, their revenue might become a bit more dispersed. That might be something that they should be looking into. Threats of substitutes, pretty related to new entrants. There's really no substitute out there at this scale. You'll have some more precision based databases that might be better suited for medicine or for certain purposes of the clinical trials. But for if you're looking for a very large scale data set across time and across geographies, different environments, you're really not going to find a better substitute than IQVIA. For competitive rivalry, it is high in the sense that there's still a lot of contract research organizations out there. For analytics, there are a lot of different there are still a lot of providers out there that provide different types of data sets. So if they are looking for, again, going back to the substitutes, very high precision data, there are quite a bit of competition out there. So it really all comes down to what they are, what the end user is looking for. So for competitive rivalry, in the sense that for certain data sets of what they need, the competition is very high. So for the board of directors, you'll have all of these members. You have one medical doctor on the board. You have one, two, three. Well, pretty much all of these are independent directors, meaning that they are not employed within the company, providing a bit more independence from the company. So this talks about what the value of these individuals add to the team. So, for example, for Ari, there's continuity. Imagine that they have, so he was both the chairman as well as CEO. So, provides the strategic vision, the deep industry expertise, and you'll have, capital markets, you have private equity, you have finance. So, you have all these different individuals bring these value adds to the team. And then these are the things that you should watch out for. So, for example, for John Den Hack, given that his background is in private equity, he might push for more transactions. The dual role, and then for Ari, the CEO, he holds both the chairman and CEO position. Not the best practice in the world, as that ideally you want the chairman and CEO to be held by two different individuals, because the board is what oversees the management team. But in here, the chairman oversees the board, and as a CEO, he oversees the management team. So there is a bit less independence in this regard. So you can read the rest on your own here. And then for the management team, as mentioned, Ari is the CEO as well. Similar structure. These are what the value add these individuals bring to the team, and these are things to watch out for. So going to the actual stock performance, it has not done very well for the past year. So this is one of the companies that I came across when screening for stocks or equities that have dropped quite a bit since year to date. There was a big jump in August, and then it kind of you know tapered out, and it's just trading range bound at the moment. So one of the more popular ratios that people look at is the price to earnings ratio, which in my opinion is not really important to know at all, but just because it's such a popular metric, I thought I'd put it here. So the way I would look at it is not the last 12 months, which is more even actually how newer investors look at it. They just look at the last 12 months, which is very, very skewed because in a high growth company, this figure will be very, very high if because the stock market price itself is trading on a forward basis, meaning that it's projecting out the discounted cash flows of the company in the next few years. But if it's expecting very, very high growth, you'll have a last 12-month P ratio that's very skewed upwards, and that's why you'll have very, very high last 12-month ratios for companies like NVIDIA and all these big tech companies. It has come down a bit, but when you look at their next 12 months, even for the big tech high growth companies, it is a bit more um, it is a bit more conservative. So if you look, what you'll see is that in for the next 12 months, as you see, like it's the P ratio for the next 12 months, it is a bit more conservative. It's not jumping around like the last 12 months, and it's meaningfully lower. Just what that means is it's trading at basically the next 15.4 times forward earnings of next year. So at 15.4 times, this I would say almost is a fairly undervalued company in comparison to where the broader market is. I believe the forward P ratio on the S&P 500 is still about 19 or 20 at the moment, if not higher. So this one is still quite low, just from P perspective. Now, the ratio that I do prefer more personally prefer more is the enterprise value to EBITDA ratios. So the reason because actually just going back to P earnings. So for what earnings means is that it's subtracting out all of the depreciation, amortization. It's also subtracting out the tax rate, and the companies can like between different companies, you can actually they can account for their depreciation and their taxes, and they can actually record earnings in a very different way from each other. So this becomes a metric that you can't really compare between companies. So it's largely meaningless in comparison to other companies, except for in relation to itself historically. Whereas for EV to EBITDA, while EBITDA is not the best metric in the world, it does provide some sort of approximation to the free cash flow, which is the actual metric that really everyone cares about, because the free cash flow is what the companies can distribute to shareholders or stakeholders after everything else is paid. So it accounts for depreciation, it accounts for interest, it accounts for, when it accounts for interest, it accounts for the capital stack. So how much leverage it has, it accounts for the taxes. So it provides a much better metric for comparison between companies. So if you look at basically the graph, the purple graph is the last 12 months, and then the blue one is the next 12 months. You'll see that the next 12 months is consistently lower than last 12 months, means that this company has been growing from a fundamental perspective in its financials over the years. And on the next 12 months basis, is only trading at about 11.8 times, which is fairly low given the growth potential of where it's at. So, for example, if a company is growing at 3%. It has a nice reasonable margin given its market. I would, you know, I would put the benchmark at about 10 times of next 12 months. But the fact that it has so much potential in the space with respect to the AI trade, and it's growing from what I recall, and we'll take a look in a bit from its financials. 11.8 times next 12 months is a very conservative metric. So, and you'll see that where the metric is at pretty much all-time lows, with the exception of, I believe, April 2025. It's at the all-time lows, going all the way back to 2017. So these are some of the revenue, net income, and free cash flow performance. So you'll see that this is the revenue. The last 12-month net income has been decreasing, which might explain why the stock has started to stagnate, and then the free cash flow per share started to dwindle as well. So likely what might have happened is that the management started to give out more conservative forward guidance starting late 2024, early 2025, and as a result, the stock might have been more muted in its trading since then. And in relation to S&P 500, you'll see that it has a positive correlation of 0.456. The beta, so this is also the other thing, right? So when people think about correlation and beta, they usually think about it as a constant metric, but in reality, these two figures does change over time, whereas before it's more of a it's more sensitive to the market at a 1.2 beta, but now it's for example in April or first half of this year, it was actually below a 1, and now it's more so at a 1.06 beta to the market. And then for shares outstanding, just meaning how many shares are out there, you'll see that it has been steadily reducing since 2022, and what that probably means is that they're just buying back more shares from the market through share buybacks, which is another form of dividends for the investors. Now, looking at the financials, now taking a look at the highlights. So we have going back to 2018 to 2024 and last 12 months, you'll see that the growth rate for the revenue really spiked in 2021, and it's been holding steady at about a 2.8 and 3.6. Gross margin fairly consistent at 35, 34, 33, and then 34 again. So it's hovering around that point. EBITDA margin, it's about the same. Net margin, so going back to earnings, earnings is the net income. It's just good to know. So they're at about 7.88 as of the last 12 months. Now, here's an interesting one. So this is something I always like to look at is capital expenditures. So capital expenditures tells me how much the company is investing into infrastructure, potentially through new equipment or new locations, and their CapEx really expanded since 2018, which means that it should be fueling more growth. And then now we look at the solvency. So you'll see that their solvency is at 272%, which is the total debt compared to equity. It is normally higher than what I would prefer, but I think this might be attributed to the fact that they are a research provider, I believe, contract research provider. So it might be the fact that they're just, their business tend to be more asset heavy, which is then funded by debt, hence a higher leverage ratio. This is the metric that I do care about the most, with respect to the leverage, is how much times of earnings or interest expense can their free cash flow cover. So as mentioned, the EBITDA is really a proxy for free cash flow, but then if you have to minus the capex, that's really the amount of capital you have or cash flow that you have to cover your interest expenses. So, I like to be a bit more conservative. So I will really only invest in companies that have at least a very minimum of a 3x coverage ratio. And I believe that's also, what banks look for oftentimes when they're lending to small, medium-sized businesses, just to have a um, very conservative coverage for them to be able to pay their loans. And then for the Alban Z score, so this is a metrics that um, evaluates how likely they are to go become bankrupt. So under 1 is very high, or under 2 is very high. 2 is not that great of a score. You do want them to be higher. Like some of the companies that I do like, in my portfolio right now, they sometimes are have at a 7 or 6, which means that they have a very low likely of going bankrupt. Now for profitability, um, so some of the metrics that I really like to look for is return on assets. It shows how much net income they're generating on their assets. Return on equity, which is that shows how efficient of a return they're generating on their equity to their shareholders. So ROE, return on equity, is a very important one. So at 20%, that's actually a very good metric. SG&A, so selling, general, and administrative cost as a percentage of revenue is at about 12%. You'll see that it's been steadily going down. So that might either mean that the revenue is going up, or the expenses is going down. And then some of these inventory or activity ratios are very important. So the cash conversion ratio is really shows how fast the company is able to convert their investments into cash. So, for example, their days of sales outstanding, which accounts for how many days on average they are collecting on their accounts receivables. So right now you'll see that it started in about 15 days in 2016 and is increasing to 26 days, which is not bad, but also not a great thing because it is increasing. That might either mean that their customers are having a harder time to pay their invoices, or IQVIA might be pushing more sales by giving more lax payment terms on their invoices. Sorry, that was accounts payable. So actually, that would be the reverse. So it's actually a good thing because on their expenses, they were paying their bills within 15 days, but now they're paying within 26 days. So because this is accounts payable and it's an expense, that's actually a good thing because they are either have the power to negotiate and push back on the payment terms, or which in the bad case means that they are more constrained from a cash flow perspective and they need to extend their payables. And then for the days of sales outstanding, so that's what we were initially talking about, the average receivables or accounts receivables. So it stayed pretty much the same starting from 2016 at 77 days, went down a bit or went up a bit to 80, went down a bit to 65, and still hovering around 78. And that just means that they haven't really changed the terms. They haven't really made much or had any changes to how they're collecting on their invoices. And then the other is days of inventory. So I guess for this company, they don't really hold much inventory, but in those that do, you'll see in the more recent years, because of the tariffs, there's been a massive ramp up in inventory to avoid the incoming tariffs that Trump is um, placing onto the market. And then lastly, we have the return on invested capital, which accounts for both the liabilities and as well as the equity investment. And you'll see that it's at about a 10% right now, which is much lower than the 20% that they have on the equity. So in the sense that the ROIC, it's it's really a unlevered position because it counts for both debt and equity. You want to compare this to the WACC. So what the WACC is really the blended cost of capital or the weighted average cost of capital that the company has. And just very generally speaking, you'll have a WACC that's maybe around 10%. I mean, you have to do the calculations, but 10% is really, or 9 to 10% is really just the default that I kind of, default to when just doing a quick comparison. So at a 9 to 10% WACC, and the ROIC is around that as well, it means that it's not really generating much return on the overall capital. And if they are at about a 4%, it means that they are actually making less return on the total capital than they are paying for the capital. So essentially, who they're paying the debt holders, they're paying the opportunity cost for the equity shareholders. So it's, as a whole company, it's not great. But if their ROE is at 20%, it means that the shareholders are the ones that are getting that that return on their investment. So from an equity perspective, as an equity shareholder, it still could look like a good investment. Whereas the overall company, um, you know, it may not be that good. But then if they have a very low cost of capital at, I don't know, 2-3% that they got from pre-rate hike days, then yes, this will mean that they are generating they are generating a return on their total cost of capital. So going to the cash flow statement, this is something I always like to pay attention to, is how are they managing their cash. So if you'll take a look, this is pretty straightforward. They're making investments on CapEx, so they have an increasing amount of depreciation and amortization. Asset write-downs and restructuring costs. I like it when companies don't have a lot of this. It just means that, if you have an asset write-down or restructuring cost, it means that you made a mistake before and you're accounting for the cost now. Normally, they will add this back because it's not a true cash outflow, but it still costs the company something because, for example, you buy, a brand and you're just buying the trademark for, let's say, 10 million, and that doesn't show up as an operation. It shows up as cash from investing. So it doesn't show up here, but then 10 years later, you realize that brand is worth nothing. So you have to write that down, and that's where this shows up. So for me, it doesn't really make quite much sense I understand why they do it, but I just look at this and that reflects to me and shows me how their management is making acquisitions or operating. Stock-based compensation. So you have to really compare this in relation to how big the company is from a market cap perspective and as well as the cash flow. So this just means that how much equity are they paying their staff as part of their compensation package. And, this will be a 10% roughly of their annual cash flow, which is a tolerable amount. From my recollection, Salesforce has a notoriously high stock-based compensation. So with a lot of startups and as well as tech companies, because a big part of the tech compensation is in RSU, stock, equity, options. So this will be a very large part. But if you're not a high growth company, having this as a bigger percentage of your cash flow, it's not something that I'm too keen of. And then for other operating activities, similar to the asset write-downs, I do prefer that there's not much happening here. Just because it's, this accounts for the things that the company's doing outside of of their main operations, whereas their focus should be, within the company. And this is not that big of a percentage compared to the annual cash flows or operating cash flows. So it's not too big of a concern, but it will be interesting to figure out and look into why there's a $1.2 billion dollar charge here. And then for changes in working capital, which is the accounts receivable, payables, on our revenues, I'm not too concerned. What that means is, if you're increasing your sales, your receivables go up, and because you're doing more business, your accounts payables go up. So this is not too big of a concern, but you have to watch out for the activity ratios of the days outstanding of inventory and sales, because if the days change, that's the fundamental, and that's the common denominator of that you should be paying attention to. So, for example, if the receivables go up when the revenues are going up, in and of itself is not a bad thing. But if the days of sales is also going up, that's a concern because it means that they're taking more time to collect on their revenue. So, and now we have cash flow from financing. This is basically showing how the cash is flowing under equity and as well as under liability or long-term liability accounts. So you'll see that they're issuing their debt mainly as a means to pay off. So this is total debt issued, and this more or less matches the total amount of debt repaid. So what they're doing here is they're just refinancing, the majority of the debt that's coming to maturity. And then you have, so this is the amount that they're being repaid, and then issuance of stock. So you're seeing that they're not really going out and raising capital or equity capital, which dilutes the shareholders like you and I. And that's actually interesting because you do see that there's a lot of stock-based compensation. So what that means is, even though they're incurring that charge right now, the staff are not likely exercising those stock options or RSUs for the past 4 years, which might be because the strike price is not of those options has not been hit yet. So, and that's a good thing. And then we have the repurchase of common stock. So this is the share buybacks, and that's really a form of dividends. I know there's been a lot of narrative on YouTube and social media that you should buy the dividend stocks. It provides a return, but the more I would say popular way of looking at that in more institutional circles now has been more of total return. So you look at both the price appreciation, you look at the share buyback, you look at the dividends. And the reason for that is because in many jurisdictions, like in the US, like in Canada, dividends are actually taxed at a higher rate compared to appreciation, which is what stock buybacks do. So when you reduce the total amount of shares outstanding in the market, the price goes up. And for those that do actually want their, I guess, their dividend, they can just sell the stock after the share buyback has been completed, and you have an equal amount on the notional value, but then you're paying less taxes on that amount. So my opinion is that actually in this environment, I would, it depends on everyone's situation, but as a general, consideration for myself, I tend to not like dividend companies because I'd much rather have it in the form of a price appreciation, and that I can control the amount of dividends I actually get at a lower taxable rate. And then, and then you have also here other financing activities. You have to look at the notes in their quarter earnings or annual earnings to figure out what this is. But it's not a relatively large amount in the grand scheme of things for this company. So overall, I would say their financing cash flows are pretty healthy, in line, and what I'd like to see. They're not paying out, or they're not issuing a lot of stock. They're doing share buybacks. They're not taking on additional loans. They're paying them off and refinancing it as needed, and maintaining that leverage ratio, which helps the overall. So for the company to have debt, it's almost like pseudo leverage for you as the investor. So as a summary, we'll just go over. So there is secular tailwinds for this company. There's tons of push from a regulatory standpoint for real world evidence. the outsourcing of clinical trials and commercialization continues to expand. Large pharma clients remain sticky due to high switching costs and regulatory familiarity. And what I like the most is their data assets, which is very difficult to replicate, but at the same time, the market feedback online and just from those that are actually using it has been that it's fairly mediocre. So, and I mean, you also have to recognize that AI as a technology has actually been around for decades. The LLMs or the natural language chatbots are what's really new, and that's more so interface of the underlying technology. So for data sets, you have machine learning, PCA, I think random forest, this is random trees or random forest. Not too familiar myself, but in doing the research, these technologies have been around for many, many years. So the results, I will almost say, has been baked in. I think the upside is for those new AI companies that do want to take a stab at this data, or in other words, to rephrase that, there is a much larger number of companies in AI now trying to tackle all sorts of problems with AI in comparison to 10 years ago. Even though this technology has existed, there were just fewer companies that might have been interested in using their technology or they're using their data set. But now with the AI boom, there's so much more compute. There's so much more, startups, founders looking to, solve various problems with AI, and that might, as a result, generate more demand for the data sets that IQVIA have to offer. So that is a major tailwind I see for the company. So the business mix is good. It's not just purely AI. It's not just purely data. It has more, economic defensive segments. You have those that are more cyclical, and then you have task analytics, which is more on the upside. So it's a fairly good mix and not a one-trick pony that's, might, be impacted severely by, one single aspect of the market or regulation. Overall, the financials are fairly good. I would say in the transcripts and just overall online research, it shows that there is the CFO transition in 2026, so that's an executional risk that we have to factor in for great return on investment, but fairly mediocre return on invested capital. But we have to look at the total actual weighted average cost of capital. If it's sub 9 in the 7.65%, like maybe 5-6%, then their 9-10% ROIC means that it's actually very, very good. And then from a valuation perspective, that's also what attracted me the most to this company, and possibly considering a position in the future is its enterprise value to EBITDA ratio. It's very low, driven probably by the slowing growth rates, maybe due to the slowness in commercializing AI and further monetizing data sets. Their buybacks are supporting the EPS, meaning that when they do the share buybacks, it also pushes up the share earnings per share because there's fewer shares on the market. So overall, I think there's a lot going for this company, but there's a lot of executional risk. It might be a short-term trade if the right levels or the right valuation is hit, like how I currently see Kenvue. In my opinion, it's very oversold. And so I think IQVIA could be a short-term trade if the pricing valuation is right. But the upside, is really kept by the data quality and the utility concern, so the data has been on the market for a while. AI has been around for, decades. The LMs have been around for, 4 years now, or 3-4 years now. So, I think the results should be showing. If it doesn't really show by the next year, I might really question the actual utility of these data sets in AI as a whole. But from a downside perspective, it is supported by scale, backlog, and entrenched pharma relationships, which is really hard to replicate. So yeah, so you gotta just look for the clear proof of data quality, differentiation, evidence of biotech funding recovery. So as market goes up, as interest rates come down, that could be a really good push for IQVIA, and as well as the transition of the CFO. So overall, I think this is a whole, but um, depending on how things go over here, it might be a long-term investment, or if it drops too much for due to non-fundamental reasons, maybe due to a scare, maybe due to a comment from Trump, it might be a good investment, or it might be a good trade in the short term. So that's my opinion about IQVIA. And then here, if you download this PowerPoint, you'll see that these are all the different companies that are in this space, what they provide, how they compare. Um, so yeah, I think that's it for now. So overall, interesting company, but let's see what happens for now.